In this lecture we are looking at provisions and warranties. In accounting, know that provisions are liabilities of uncertain timing or amount, sometimes referred to as estimated liabilities. Companies accrue an expense and related liability for a provision only if and when three conditions are met. A company has a present obligation as a result of a past event. B. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and circa a reliable estimate can be made of the amount of the obligation. If these three conditions are not met, no provision is recognized. Now we look at warranties, which are an example of a legal obligation. The amount of the estimated warranty liability is determined by weighing all possible outcomes by their associated probabilities to arrive at an expected value. Refunds are an example of a constructive obligation that derives from a company's actions where a. by an established pattern of past practice, published policies, or a sufficiently specific current statement, the company has indicated to other parties that it will accept certain responsibilities, and b. as a result, the company has created a valid expectation on the part of those other parties that it will discharge those responsibilities. The amount of the estimated refund liability, where each point in the range of refunds has the same probability of occurrence, is usually the midpoint in the range. Litigation liabilities, which depend on the probability of future payment, are best measured using the most likely outcome. Common types of provisions. 1. Companies generally report only one current and one non-current amount for provisions in the statement of financial position. 2. The IFRS requires extensive disclosure related to provisions in the notes to the financial statements. Lawsuits. A. The recording of a liability will depend on certain factors. 1. The time period in which the underlying cause of action occurred. 2. The probability of an unfavorable outcome. And 3. The ability to make a reasonable estimate of the amount of the loss. B. The cause for the litigation must have occurred on or before the date of the financial statements. Circa a liability is accrued on unfiled suits and unasserted claims, assessments if 1. It is probable that a suit will be filed or a claim, assessment asserted. 2. It is probable that the outcome will be unfavorable. 3. The loss can be reasonably estimated, and 4. The cause of the action is dated on or before the date of the financial statements. D. Most companies provide a general provision for expected costs to be incurred without relating the disclosure to any specific lawsuit. Warranties. The amount of the liability is an estimate of all costs that will be incurred after sale and delivery. A. Assurance-type warranty. 1. Cost is included in the sales price. 2. The entry made at the time of sale. Debit. Warranty expense. XX. Credit warranty liability. XX. 3. The entry made when incurring warranty costs. Debit. Warranty liability. XX. And credit cash, inventory, accrued payroll. XX. B. Service-type warranty. 1. Sold separately from the product as an extended warranty. 2. The entry made to record the sale of warranty. Debit. Cash. XX. Credit you-earned warranty revenue. XX. 3. The entry made at year-end to recognize revenue. Debit. Unearned warranty revenue. XX. Credit warranty revenue. XX. Contingencies. Contingent liabilities. A. Are not recognized in the financial statements because they are 1. A possible obligation, not yet confirmed as a present obligation. 2. A present obligation for which it is not probable that payment will be made, or 3. A present obligation for which a reliable estimate of the obligation cannot be made. B. General guidelines for accounting and reporting contingent liabilities are 1. If it is virtually certain that a liability will occur, probability at least 90%, record the liability. 2. If it is probable that a liability will occur, probability 51 to 89%, record the liability. 3. If it is possible but not probable that a liability will occur, probability 5 to 50%, only the disclosure is required. 4. If it is remote that a liability will occur, probability less than 5%, no disclosure is required. C. Disclosure should include 1. A brief description of the nature of the contingent liability. 2. An estimate of its financial effect. 3. An indication of the uncertainties relating to the amount or timing of any outflow, and 4. The possibility of any reimbursement. 1. Presentation of current liabilities. A. Recorded and reported in financial statements at their full maturity value. B. Presented after non-current liabilities in the statement of financial position. C. Accounts may be listed in order of maturity, descending order of amount, or order of liquidity preference.